Hey everyone, Logan Hertz with Hazeltine LLC. Today we have with us Peter Nelson, as always, with Nelson Insurance Advisors. And I want to talk about a subject that is actually near and dear to Peter's heart. Um, Peter, of course, naively believes everything that Wall Street and the financial powers that be tell him. He, of course, parrots their studies back to his clients because, of course, the people who promote these financial studies and so on have no ulterior motives. They are only trying to help people. And of course, everyone I know who has put their money into standard Wall Street vehicles has gotten rich, right, Peter? Or did I miss something?
Right. Yeah, just put it in, just keep on shoveling it in there, and market just keeps on going up, right?
Yeah, so I sometimes talk about the four rules of financial institutions. Peter sometimes likes to talk about the three lies of Wall Street. So, Peter, you want to enlighten us on the three lies, myths, whatever you want to call it, selling points, the psychological manipulation tactics disguised as financial strategies that Wall Street will use that are oftentimes parroted by many people, sometimes very intelligent people, sometimes people very intelligent in the financial sector with a lot of degrees and qualifications, as if these were obviously true. But I would say they might be obviously untrue once we unpack them just a little bit. So you want to walk us through some
Yeah,
of those,
so
Peter?
I'll give you a quick summary. And by the way, if I'm like shot in the next week or two, then you probably know why, right? After going through this, right? Okay, so these are the three lies of Wall Street or myths of Wall Street, whatever you want to call it. So first one, of course, is buy and hold. Higher the risk, higher the reward, and it's just the paper loss. So I think we should go through each of those individually, because sometimes there are some truth to some of them, but at the same time, it's almost become like a religion, and that's where I kind of say, like, no, like we got to rethink this a little bit. So let's
Yeah, I
unpack
just want
each
to point
one.
out one thing. We could go through a whole series on this. A half truth is far more effective than an outright lie. Outright lies are not effective, right? So I believe I'm quoting Lawrence of Arabia when he says, a man who tells a lie merely hides the truth, but a man who tells a half truth has forgotten where he put it. And usually when we are given advertising, marketing, whatever, these what I would call tools of psychological manipulation, they don't just outright lie. That wouldn't be very effective. People would probably pick up on that. They tell a half truth. They start with something that's true and they kind of twist it a little bit, right?
Right. Yeah. So I mean, like, let's take the first one. And there's actually a book, so buy and hold. Okay. So Moshe Milevsky, a gentleman, he's considered to be one of the top 10 most brilliant retirement income. He's a professor up in Toronto at a university up there, and just about everybody in our field has heard of Moshe Milevsky at one point or another. He's absolutely brilliant, and he actually talks about this. And I do have the book. I should have had it ready, but I didn't. But anyways, he talks about pretty much putting a dollar into the S&P for like 50 years. And one way was just buy and hold and let it go the whole way. Okay. And the other way was that you would not participate in the 15% of the best months, but at the same time, you wouldn't participate in 15% of the worst months, to be fair, right? And Logan, after you did that for like 50 years, guess what? Which one do you think was actually better?
Well, I'm pretty sure it was the indexing strategy where you're missing out on the best years, but also missing out on the worst years, right?
Correct. So I think it ended up $182 you ended up with if you did the buy and hold strategy where you just took all the ups and downs, but you ended up with $529. I'm pretty sure because I talk about it enough. That's a big difference.
More than
Okay.
twice as much. Yeah, it did more than twice as well. And I think that
Yeah.
that's an interesting point too, because people, sometimes think it's all about maximizing your rewards and you want to be in it because of those great up years. But what you're showing is no, actually, what's far more important is avoiding the down years, right? This is something that
Yeah,
I think experienced investors understand is that it's more important to limit your losses than it is to maximize your gains, right?
yeah. I was just trying to find it real quick, and I got it here somewhere. But yeah, and then people say right away, by the way, they're saying, well, you should, you got to factor in the dividends. And actually, Moshe Milevsky does factor in the dividends. The numbers are slightly different, but still, or you can reduce that 15% of the worst months makes a huge, makes a huge difference. And then you say, well, how can I do that? Well, there's a lot of ways to actually do that. That's where we talked about in the last one about having a non-correlated asset class. You could actually use some types of annuities can kind of replicate that to a certain degree. But the whole point is, without getting into like the nitty gritty here, is that buy and hold to a certain degree is wrong. Now, buy and hold has done really well at some factors, okay, in some time periods, right? Like we just saw over a 10-year bull market, right? That was a good time just to let it go, put the money in a NASDAQ linked index and just let it fly, right? But then there was also some really ugly downturns there that can also skew the numbers, right? We had 2020, right? The COVID crash. We only had 2022. And then we have to factor in, right, Logan, the sequence of returns. And if you're young and you're just letting it go, okay, maybe that's fine. But if you're in retirement or nearing retirement, that sequence of returns may not work out well. So there's a lot in regards to this.
Yeah, when you buy and hold, you are maximizing your risk exposure is really what you're doing because you're always in the market. So, right, you're always at risk. You have no protection on the downside whatsoever. And the other question is, well, buy and hold. Okay, who's holding it? Not you. Wall Street is holding it. There's at least some custodian who is holding it, who is profiting from you, who is incentivized to want you to keep your money with them for as long as possible, right? And never touch it. To me, buy and hold only makes sense if you have a real asset. And by that, I mean an asset that is generating income. So a real estate investor will buy a rental property and he'll hold it for his entire life. That makes sense because he can hold the property and benefit from it. He's collecting rental income. He's probably leveraging it by borrowing against it. That whole time, he's collecting income. So he's actually holding the property and he's actually benefiting from it that whole time. The problem with buy and hold is that you're putting money into an asset, if you want to call it that, where the only time you benefit from it is when you sell it. So if you hold it for 30 years, that means you got no benefits from it for 30 years, none, right? We invest for cash flow, not capital gains. A real investment pays you like a business, like a rental property. If you are collecting income, then it makes sense to hold that asset because that's a real asset that's paying you that you're benefiting from. So why would you sell it? Only if you can get a better asset, right? So that makes sense.
Absolutely.
Right.
And Logan, I did actually, I want to share this real quick. I did find it. So I'm just going to share this. Just want everybody to see this real quick. So here's the book. You can get it on Amazon. I'm not going to go through the whole thing, but there's Moshe Milevsky. Here it is. All right. So the money's invested from January 1970 to December of 2020. Okay, $1. Okay, so here's your fully exposed column. So you end up with $182. But if you take out the 15% of the worst months, but also give up 15% of the best months, you end up with $529. That's a 291% increase. Okay. Now there are certain months, certain decades here, tranches as they call it, where the fully exposed may end up better. Okay. But there's a lot of tranches here where, like right here, and from 1980 to 1989, the fully exposed does a lot better. Okay, but this is really, Moshe Milevsky actually talks about this, by the way. He said he almost fell out of his chair when he ran the numbers. He did not expect the numbers to be this big. And it says right up here, you're going to give up the best monthly trim percentage exchange for protection against the worst monthly. Okay.
And the reason why is when you suffer a loss, it's much harder to recover, okay? Because now you're coming from a smaller base. So sometimes people will think, so if the market goes down 50%, and then the next year the market goes up 50%, your average return between those two was 0. So people will think, oh, so I'm back to where I started. No, you're not. No, you're not. Because that plus 50% in year 2 was starting from a much smaller base. You only had half the amount of capital in there. So you need a 100% return. You need your position to double in year 2 in order to make up for that 50% loss in year 1. And the same thing applies with anything. So if you have a 10% loss in 1 year, which wouldn't be catastrophic, well, now you need a 20% gain in the next year to get that back. My math might be a little bit off, but the point is your portfolio has to work a lot harder to recover from a downturn, right?
Yeah. And by the way,
so the down years hurt you a lot more than the up years help you. That's just the way that mathematics works. And this is why average returns are not the same as real returns, right? In the example, simple example I gave you, your average return was 0, but your real return was significantly negative, right? I think your real return was negative 50% or negative 25%.
Yeah. And by the way, even here, do you notice, even if you just can cut back on the 5% of the worst months, you actually have a more optimal solution. Okay, so this is going back, and I'm going to stop sharing that, but I just want everybody to see that and go get, we don't get anything for talking about that book. You can go out and get it on Amazon, but it's important to talk about risk mitigation. They want to act like just buy and hold is just let it fly, because you talk about this all the time, Logan, right? Just give us the money, keep on giving it to us, and just, that's what Wall Street says.
And don't touch
right?
it. Don't ever touch it. Don't ever touch it. Don't ever take your money out of our jail. Don't ever touch it. We're making more money if you leave it with us, right?
Yeah. Yeah.
So yeah. So
Anyway.
maybe the advice given there is a little bit self-serving. And again, there is a kernel of truth to it, for sure. I would say you want to have a long time horizon, generally speaking. That doesn't mean you lock your money up in jail. I personally, I never want to lock my money up in jail. I value liquidity above everything else. I would much rather, just putting aside infinite banking, all the stuff that I know about, I would much rather have my money in a savings account earning 4% than put it into the market, because I have much more liquidity in that savings account. I can take the money out anytime I want, right? And I don't have to worry about it potentially being down 30%. Right? It's just, to me, it's not worth taking on the risk, and I have no control over it, and I have no control over the outcome. Right? So to me, buy and hold only makes sense if you are holding an asset that pays you, like real estate, like a business, right? If you're holding a real asset, then that makes a lot of sense. Right? The problem is, when we say buy and hold, you're not actually holding it. Somebody else is. And they're charging you for that, and they're making money off of you in lots of surreptitious ways. You can look at my video, how much money do you have in the bank? When you put your money into a Wall Street vehicle and you have, say, mutual funds, you actually don't own those. You own nothing. The custodian owns it, and they turn around and they can loan your shares out to somebody else. They can front run the order flow. So they're making money off of you in a lot of surreptitious ways outside of just charging you a 1% fee, which, by the way, that 1% fee over time adds up to be quite a bit, right? So I'm going down a rabbit hole a bit here, but my point would be, aside from, because you're just talking probability, like what's the probability? And you're showing the probability is that you'll do better with more of an indexing strategy where you're protected from the downside, right? I don't like talking probabilities, right? I want certainty. I want control. I don't really get into the whole gambling thing, but you're pointing out that even if you take Wall Street on its own terms and follow through the probabilities in a disciplined manner, you see that even that doesn't work out, right?
Right. I think what I'm talking about is risk management. Okay. If you can manage the risk to a certain degree, you can have a more effective and efficient portfolio, right? Incorporating cash value life insurance into it, possibly incorporating an annuity into it to help mitigate that risk. And by the way, you mentioned something that's very interesting. So if everyone, and I have it right here as a reminder, the VIX, which is the Volatility Control Index, everybody remembers around August 5th when Japan was going haywire and the markets were like this. I made some trades for some clients. I think they were all ETFs, exchange traded funds. It was taking forever to get the trades done. And I use one of the largest custodians out there, okay? Everyone's got to understand, if everybody's selling and nobody's buying, how are you going to be able to get out of your trades? You're not, okay? Very, very important. I was stunned how long it took.
Yeah, Peter is talking about counterparty risk, which is something that most people have never heard of. It's not just market risk, it's counterparty risk. You are relying on a third party to do this, to hold it for you, do a lot of things for you. You can look up MF Global as an example and see what happens when the counterparty goes bad and you're left holding the bag. And by the way, that counterparty doesn't get sued and no one goes to jail, because technically when you put your money in Wall Street's vehicles, they actually own it, not you. And so whatever they do with it is perfectly legal, right? So yeah, so it's not just market risk. It's you're relying on somebody else now to execute those trades. What if they don't execute it in a timely manner, right? That can make a big difference when the market moves quickly, right?
Now they're going to say the
Yeah, and,
argument's going to be,
and the other
well,
reason, Peter, is because what they do is they front run the order flow, right? So one of the reasons why those trades take so long is because that's part of how they're making money off of you. So if they see a bunch of sell orders come in, they will kind of delay executing those sell orders so they can first buy a put option. Then they execute those sell orders, driving the price down. So then they can sell their put option at a profit, right? So it's kind of up to them as to when they want to execute your trades. There's no guarantee that they're going to execute your trade in a timely manner.
yeah, well, and also someone will argue, well, you're talking about buy and hold here. Yeah, I understand we're talking about buy and hold, but at the same time, at some point, we don't have, an infinite amount of time to have the money invested. At some point, the point is to make some money on it and then to access that money. Well, that's the only issue here. And look, I handle that kind of stuff, but just understand that if you need money and the market's going down and everybody's selling, like that happened around August 5th, it's not easy to get out. Now, it was a temporary thing. I think it's actually foreshadowing something much bigger coming down the road. Because the VIX went from like 15, which is like nothing, to 65 practically like that. And I was chided recently before this happened. I said, watch the VIX. And then they said, well, the VIX is like at 15 right now. Well, the VIX can go from 15 to 65 like that because it's a volatility control index to foreshadow where the market is anticipating where volatility is going. Well, when Japan all of a sudden technically blows up overnight because of what they called the carry trade, because we're in a global market, it can go to real fast is all I'm trying to say there. So I think we've talked about buy and hold.